This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.
When it comes to income generation, usually investments that are the most favorable are those that have the highest dividend yields. But the key here is that you need an income generating instrument that has longevity. You want to make sure that it generates consistent and reliable income over many years, otherwise it is useless. And so this means you have to consider growth. Having income without growth means that an investment will likely suffer from NAV depletion, which can be detrimental in the long term. But having growth without income exposes you to a lot more downside risk and volatility, which may not be suitable for investors who prioritize consistency and longevity. But you'll also find that growth is often sacrificed in order to provide income. So it's almost like an inverse relation. And the perfect examples are passive dividend ETFs and high income ETFs. High income ETFs, which are your typical covered call ETFs, have much higher dividend yields than passive dividend ETFs. However, these yields are a direct result of sacrificing a lot more capital appreciation. And you can see exactly what I mean when you look at their overall return charts. Sacrificing growth will always underperform in the long run, especially in a bull market, because these ETFs cap growth potential for income. Although you have to compare them with the underlying index that they track. So for example, you have to compare SPYI with SPY and JEPQ with the QQQ. Now, on the other hand, passive dividend ETFs like SCHD and VYM only provide yields between 2 to 3% and mainly rely on their growth ability to provide returns. These ETFs also rely on the dividends distributed from their underlying holdings, which may simply not be enough. But after a lot of comparison, I've noticed another problem. You see, high income ETFs tend to have much less volatility when compared to passive dividend ETFs. And that is because the frequent high income distributions compensate for the price fluctuations very well. And you can see it right here. That is also why their beta values are much lower. But like I said, passive dividend ETFs are better able to appreciate in value in the long term because they do not cap their upside potential. So it's almost like these two forms of income investments are on two opposite sides of the spectrum and both leaning towards the extremes. So the question is there an investment that combines the best attributes of both into one, creating that sweet spot for dividend investors and retirees? A spot where the dividend income is strong, high enough to be used as a reliable source of income, and can be a tool to minimize volatility like a high income ETF, but also provides substantial capital appreciation like a passive ETF so that it can work hand in hand with its high dividend yield to provide substantial compounding growth. And this brings me to DIVO, which is the Amplify CWP Enhanced Dividend Income ETF. Now, before we continue, I wanted to let you guys know that I just released a free dividend ETF cheat sheet that breaks down the 7 key metrics every smart investor should know, plus my #1 way to spot a dividend trap. You can grab your free cheat sheet by clicking the link in the description or comment section below. This ETF is one of the most interesting funds out there and is, in my opinion, the sweet spot between dividend income and capital appreciation. Now, I have frequently thought of this ETF as the top 4 dividend income ETFs available, and in my honest opinion, it needs more attention. But I also just stumbled upon some very interesting data that can be very valuable for all investors moving into 2025. So pay very close attention and stick around until the end because you don't want to miss it. DIVO was established in December of 2016, and it currently has over $5 billion of assets under management. The fund currently has an amazing dividend yield of 4.7% with a 4-year average yield of 5%. This is substantially higher when compared to majority of other dividend ETFs, including SCHD. However, it is lower when compared to high-income ETFs like JEPI, which has a yield between 7 to 8%. Now, for this video, I will be comparing DIVO with SCHD and JEPI.
Year to date, the fund has returned almost 12%, in line with the S&P 500, and heavily outperformed outperforming SCHD and JEPI, which have returned 2.7% and 4.8% respectively. Since inception, with dividends distributed, Divo has returned almost 180%, heavily outperforming SCHD, which has returned around 150%. And this is all due to its unique strategy and growing dividends, which I'll talk about in just a second. Now, of course, like I said, the ETF is sacrificing capital appreciation for the higher yield. That is why when you look at the fund's price return since inception, you see that it is underperforming SCHD. But if you compare it to a fund like JEPI, then you're getting much better capital appreciation, essentially sitting in this sweet spot with strong growth and a strong dividend yield. This is actually very tax efficient, and I'll explain that in just a second. And if you guys want access to these amazing tools along with in-depth fund analysis, market insights, ETF breakdowns, and more, then I highly suggest to sign up with Seeking Alpha. You guys can use my link to get $30 off their annual premium plan. You can also save $160 off their Premium and Alpha Picks bundle. And Alpha Picks is Seeking Alpha's premium stock picking portfolio that uses momentum, quantitative data, and a disciplined approach to identify stocks with the highest growth potential. And since inception, this portfolio has provided 3 times the total returns of the S&P 500. And I personally use these tools together every single day, so I highly suggest you guys take advantage of the sale. But going back to its dividend yield, probably one of the most important attributes of this ETF is that its dividend yield is distributed on a monthly basis as opposed to a quarterly basis, which gives investors the ability to capitalize on the compounding effect by reinvesting every month. And on top of that, the frequent distribution helps minimize the fund's volatility much better than passive dividend ETFs. And this for me kind of takes it to the next level. You can clearly see that Divo's betas is almost perfectly in the middle of SCHD and JEPI, showcasing a good mix of a high-income ETF and a passive dividend ETF. And for those that don't know, beta simply represents the volatility of an asset relative to the overall market. The closer the value is to zero, the less volatile it is. You can see that on a downward trend, this ETF resembles a high-income ETF like JEPI, but on the uptrend, it embodies more of a passive ETF like DGRO. This is something that I didn't notice before. When you look at the fund's overall performance in the bear market of 2022 and compare it side by side with SCHD and the S&P 500, you can see that it was able to provide superior returns, losing only 1% in value versus SCHD, which lost around 4%. And the superior dividend yield of DIVO is what gives it that extra edge in a bear market. All right, so how does this fund work? Divo is an actively managed ETF that provides income by selecting stocks from the S&P 500 index and at the same time uses a tactical call writing strategy. This means that the fund manager is actively deciding which stocks are best suited to write covered calls on. So they don't sell calls on broad indexes like the S&P 500 or the Nasdaq 100, where the calls would cap the growth potential of every holding. Instead, they are very selective, which in turn helps with the fund's growth ability. And I love this about the fund. The fund aims to generate 4 to 7% annual gross income from 2 sources: natural dividends and option premiums. And this is where the fund's tax efficiency comes into light. The fund is using a combination of both qualified and non-qualified dividends, where 2 to 3% is qualified and 3 to 4% is non-qualified. So what this means is half of the income is qualified and is taxed as capital gains, while the other half is non-qualified and is taxed as regular income. But here's what's really interesting. Of that non-qualified portion, which is generated from its covered call strategy, around 50% of it is considered return of capital. And you can see that when you look at the fund's tax information. This is a little bit complicated, so I'll cover it in another video. But what that means is that half of the covered call income is tax deferred and is eventually taxed as long-term capital gains. Return of capital dividends is a classification of dividends that high-income ETFs use in order to make their dividend distributions more tax efficient. I do have a video that explains return of capital in detail, and you can check it out right here. So this is a lot more tax efficient compared to an ETF that strictly provides non-qualified dividends. Of course, if you're investing in a Roth IRA, then this doesn't matter because all gains and dividends are not taxed. Now, the manager writes short-term covered call options using only 20% of the fund's assets, while the remaining 80% is left to appreciate in value like a regular passive ETF. What's really important is that the fund has an emphasis on owning high-quality, large-cap companies with historical dividend growth and earnings growth. And this is where you need to pay very close attention. Strong earnings growth is a key attribute that is giving this ETF the ability to appreciate so well.
There is a 100% correlation between the company's growth potential and earnings growth. But stocks with strong earnings growth don't necessarily have high dividend yields. However, DIVO doesn't need to focus on that because the option strategy can compensate for the stocks that have low yields. This is so important and is an attribute that I feel puts this ETF above many passive ETFs, including SCHD. SCHD does not use earnings growth as a stock picking criteria. Instead, it uses something called IAD yield, which focuses on stocks with the highest dividend yield. And this is how SCHD tries to provide its dividend yield. And I've said this time and time again, but this actually works against the ETF because it disregards some very powerful stocks with substantial dividend growth, strictly because they may have a low dividend yield. But DIVO doesn't have this problem, so it can focus on very strong momentum stocks. And that is why since 2023, Divo has been able to crush SCHD in total returns because it was able to focus on stocks with very powerful earnings growth, which, as we all know, was concentrated in the tech sector. Okay, so now we have to talk about this fund's major benefits and downfalls. The biggest benefit, apart from its ability to grow and mitigate risk so well, is consistency. As mentioned before, the fund is using a combination of both qualified and non-qualified dividends at almost an even split. And the part that is qualified will always be there. So at no point will the dividend yield fluctuate by any significant amount. Now, the problem with call writing strategies is that the premium income is heavily influenced by volatility. And I did highlight this in one of my previous videos, where I explained the reason behind the heavy fluctuation in dividend yield of covered call ETFs like JEPI. So this consistency in dividend yield gives investors that peace of mind knowing that majority of the time their dividend yield is going to be around 5%. And when you look at the fund's dividend history, excluding of course its first year and the pandemic crash, the yield has remained constant every single month.
Although over the past 12 months, Divo has actually increased its dividend distributions, pushing its dividend growth rate above 10% for the first time. That is well ahead of the median for other ETFs in its category, which is a very good sign moving forward.
So this brings me to the main question. Why has this ETF only been able to accumulate $5 billion of assets under management? Considering all of its amazing attributes, this makes no sense. I do think it's all because of its terribly high expense ratio of 0.56%. So this one factor has caused investors to completely overlook all of its great attributes, which honestly, I think is kind of a shame. Yes, of course, when you compare a 0.06% expense ratio with a 0.56% expense ratio, it is more than 9 times as much. However, you do have to consider the big picture. You're getting a fund that is able to provide more returns, mitigate risk better, and is able to provide a more frequent and higher source of income, which also helps minimize volatility. Now, there's also concentration risk. This fund only holds around 30 individual assets, which is highly concentrated, and the percentage of assets in its top 10 holdings is more than 60%. But I do think that this is more of an advantage for the ETF because it allows it to grow without over-diversification dragging its performance. Overall, DIVO is a very unique fund that uses a combination of qualified and non-qualified dividends to produce a very attractive and, most importantly, consistent dividend yield of around 5%. Accompanied with a monthly distribution and its ability to appreciate in value, you have a very attractive financial instrument for income investors, retirees, and growth investors. If this ETF was a little bit cheaper to own, I am very confident that by now they would have upwards of $10 to $20 billion of assets under management. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit the thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one.